let's just go over to our YouTube channel real quick. We had some discussions this week. Here you're taking a look at our playlists, and we added some new ones: market hedges for unexpected events, earnings, and more. Not just talking about married puts, but talking about VIX calls, bear put debit spreads, or buying puts directly on SPX, QQQ, playing inverse ETFs and more. Technical analysis tools and power options, the search criteria, how we set up the graphs, what technical criteria available for you. We've got a lot of strategy ones here. There's like 8 or 9 videos, and each 13 videos here for callers, 10 videos here for bullet call debit spreads. These are designed essentially to walk you through step A through Z. What is the strategy? How can you use the tools to implement the strategy? What criteria would you look for in the search for these strategies? What alerts might you set? How would you manage these positions if the stock goes in your direction, if it doesn't go in your direction? How to develop a trading plan for this strategy in your personal portfolio. There's some of the ideas that are discussed in this playlist. You know, everything from buying calls, calendar spreads, credit spreads in addition to debit spreads, simple covered calls, cash secured puts, earnings discussions, and much, much more. So that's a great place to get started if you're looking to start a new strategy there, looking to get into it, but have some questions on that. But where I was going with that is last week we had discussion of managing a married put with a sudden earnings move while we're on the topic of married puts. And we talked about part 1, just the introduction to the married put, what expectations are. Part 2, what to do in an up direction. We see a large gap. I'm in a married put. I had a large gap on the stock. Had a gentleman today on a coaching session ask about, he had a married put on Generac, GNRC. But he had sold the call a couple weeks before earnings, and it blew through his call strike price. I think he had the 165 or the 170, and it moved up to almost 190, a little bit below 190. But he's looking to roll the call up and didn't know which strike to use. So we used the portfolio tool and the rollout opportunities I just showed to help us analyze what would be best for him and his SIGA model. Part 3 with a sudden down move, and then part 4, sort of the review with the concepts of the idea of don't panic. See, the great thing about the married put position, I mean, we saw that with the Planet Fitness trade a moment ago. We only have a 4% risk on this trade with the 105 put in place, and I can almost bulletproof that. I can bulletproof it right now, and I can almost bulletproof it using just subtle moves that cost me less and get income and leave the upside open. Now, ONON is a different position. ONON holding here has been all over the map. We opened this position, we re-entered the stock at 527. We initially opened this position almost 4.5, 5 months ago. And you see here, the last 3 months has been rather tragic. And then there was this sudden pop upwards. Now, I want to keep in mind here, I'm holding a 57.5 strike put on this trade that expires in a couple months. But let's go ahead and change this to the 6-month chart, maybe even beginning of the year. I'm going to go year to date, actually. And our original purchase price was around, let me see, let me line that up there to 57.5 for us, folks. There we go. All right, 57.5 right there. My original purchase price on ONON was $59. And we're trading at 45.34 right now. We're down 23.2% on this stock position. We got in back here at about 59. Might have been earlier, but I think it was in this time period. And we had this large drawdown. And what is that drawdown looking at? Well, you can see, right? You remember this. This was that April decline. The whole market was falling into April. Now, right at this point, we started to see the buy signals on the market sentiment tool, the light buys, and then they turned to strong buy warnings on the market sentiment tool. Now, I had already moved the put down from my original strike, which I think was 65. So my 65 put here, we had a good married put position, $59 stock, 65 put, probably about a 7% risk. The stock fell, and I rolled down the put, I think, into this range. What did that do? It reduced my cost basis, but increased my risk to about 9%. Then when it dropped down here, we rolled the put again from the 55 level down to, oh God, I don't think it was in the 40s, but it might have been the 47.5. Now the stock started to come back up. All right, so we sold a call here, got assigned. I still have the put. You know, it's still out in time. I still have got a 55 put here. The stock is around 51, 52. We sold. No, I'm sorry, it's back here. This is where we sold the call We did get assigned on the call here. We sold a put on the position which expired, and we sold another put that we got assigned on. So now we're back in the stock position, move the put back up to the 57.5, and then this happened. So I used the put, I think, 4 times, rolling it down as the market fell, following the rules in the blueprint, then moving it back up, selling a call once or twice in these ranges here, and our stock's down 23%. We're currently at a bulletproof position of 3.3%, and we're at a liquidation value of about 3.4%. Even though the stock's at 45.34, we lowered our cost basis with all those put moves and other income methods down to $49. So we lowered it by 10 points, essentially, from $60 down to $49 is what we're looking at here. This is really 59 to 49. And the stock's trading at 45.34, but we're holding that October 57.5 put. In the discussion we had last week, what is the benefit of having a position like this going through earnings? Well, ONON beat earnings, beat estimates, and increased their guidance. And let's go back to just a 5-day chart. Oh, sorry, I got to go to, let's just go hourly on the 5-day, okay? All right. Here you can see the earnings. Yeah, where were we? We were right where we were before the earnings event. We're trotting around this $46, $45 range right before earnings. Stock opens at 53. Couldn't catch that in the moment because it was really back down to 49 within the first 10 to 15 minutes. We can go back to a 3-day chart and see that. But okay, it's up here. It's at 49. I've got the 57.5 put, remember? The stock's at 49. It's come back up. I have the opportunity to adjust that put again. If I move the put down, I'm going to lower my cost basis. But the risk might actually increase because the amount of credit I'm getting from selling the 57.5 and say moving down to the 50 would only be maybe $4.50 or $5. But I'm lowering it by $7.50. So my monetary risk actually increases even though I've lowered the whole cost basis and my break even on the trade. The when and how and whys to do this are discussed in the blueprint. So you say, oh, I've been sitting on this position with such a deep in the money put for so long. The stock's in a quagmire here at 45. Mike, why didn't you just sell it to begin with, take that 4%, 3.5% profit, move on to something better? Because earnings were coming up. I wanted to see if this panned out, and it did. Everything they did was golden, and they settled. Market decided they're going to settle in this range of about 49. Up about 10%. From where they were before they closed. And yeah, not quite 10%, 7.5%, 8% is what it was. Okay, so the next day, this is market weakness here on Thursday. And it just wasn't a great day, wasn't a bad day. Tried to push up, tried to come back down. There's some other global news, but hey, we're still middling in this range, 47.5. It could come back up, I could roll down. And what is this? Strong earnings, beat estimates, beat revenue. Raise guidance for the year. But Jefferies comes out this morning and says, no, we're downgrading them from hold to underperform because we don't think that they're positioned enough for the long term against Nike and other ones. And the stock went lower than where it was before. How does this relate to the topic at hand? How does this relate to the discussions we had last week? In the review of both discussions that we had, in that little mini series that we did with managing a married put with a sudden earnings move, one of the important discussions we had is don't panic. The opportunity is there. It's still going to be there potentially a day or two later. What did I risk? What would I have risked by moving my put back down into this level, back down to the 50, maybe 52.5 range from 57.5? I would have increased the risk on the trade, thinking, okay, that's okay because it's gangbusters earnings, raised guidance for the year for 2025. It's going to continue to move up. I've got a lower break even. I can move that put back up. I can do that income method number 6 position and leave the upside open as it rises. But then the next day, the market isn't so strong. It didn't do the performance that I want. And then on the third day, you get an underperform rating and the stock's lower than when it was pre-earnings, when they had a fantastic earnings, one of the best earnings reports they've had in about a year and a half. Now, yes, it's creeping right back up right now, seeing that sort of short-term MACD coming back to a potential crossover, but I'd be in a worse position on now had I had the knee-jerk reaction to that earnings and said, yes, everything's rosy and it's going to continue to go up. I waited. Don't panic. Don't have a knee-jerk reaction. Wait to see what happens. Now I'm reassessing the position. May just close it for that gain with the stock down 23%, closing out for about a 3.4, 3.5% gain. But of course, wait to see what happens on Monday or Tuesday. We start to creep back up. I'm in that position again now that I think the stock is shaking off this underperform rating by Jefferies and can still move forward in a positive way. So again, one of the great things about this strategy is that you don't have to worry about earnings. At the same time, of course, I did have a coaching session with a gentleman. As I mentioned, it was actually, I apologize, it was an email discussion I had with a gentleman who was in, let's go back here to Generac, and let's go back just 1 month, I apologize, GNRC. Now, he's restudying the married put position, and two of his favorite stocks are NVIDIA and Generac. Sorry, folks, I went a daily. I forgot to change that. My apologies. There we go. And, of course, they had a nice spike with their earnings. They've consistently moved up. Well, he got into the stock at this range, in the 150 range. Has a 155 put, if I'm not mistaken, but in this range sold a 165 call for September. And so it spiked up with earnings and then continued. What did we see with the income method number one in the married put when we took a look at the profit and loss chart and the position analysis? You enter sort of a calendar spread. You've got a skewed profit and loss chart where your max profit's here, right at the short call strike price. But then depending on your structure, it tails off just like a calendar spread would. Because why? Because my short call at September or at August expiration is doing what now? Now that the stocks, this is 165, of course, we're up to the 195 range. Well, the short call is going to a delta of near 1. If it's August, it's at a delta of 1 now. It's in the money. As we near expiration, it's at a delta of 1, which means it's a negative because we sold the call. So we're completely negating the delta of 1 that we own on the stock. And at the same time, as the stock continues to move up, what's happening? Our put is going down and down. So we've washed any gain on the stock in this case due to the buyback cost of the call. And the put is still declining. So that's where that curve happens. We start to lose at the peak because we no longer have positive delta on this trade. We're giving it back because of the short call. Yeah. Then we talked about the income methods. We talked about the rollout opportunities that were available for him in the portfolio to evaluate what he could do with that call that's deep in the money. But this just illustrates another thing about why the blueprint, the full course on what we're talking about, the married puts here, the 13 different income methods, is that income method number one position. And you say, oh yeah, I heard Mike's videos. I see he's buying a put. I see he's controlling risk, but I'm just going to start selling premium right away. I'm going to force selling weekly premium on the position right away. Well, I don't sell the call around earnings. I don't do income method number one if I have earnings coming up between now and the option expiration. I might use that income method number 6 we took a look at a little while ago. I might just leave the upside open and not do an income method. I might do a version of income method number 5, a ratio call spread that can leave the upside open done in the proper way. Or it can cap the upside and give you more profit than the income method number 1 would do if things work out the way you want. But that's all what's discussed, of course, in the blueprint. And we talk about the married put there. The blueprint, of course, is full, electronic access. It walks through the basic structure, your 13 different income methods, the SIGA model for deciding when to choose and when to use each of those income methods. But what's the goal here? Instead of a covered call, popular strategy, probably still the most popular option strategies, because even investors that are trading 0 days to expiration spreads, condors or butterflies, trading spreads, weekly spreads on indexes or ETFs, all the new buzzwords that come out, jade lizards and things of that nature. You probably have stock in your portfolio, even though you're trying these other option strategies. You're saying, yeah, I've got dividend aristocrats. I've got things I've been holding for years. I got Apple at a cost basis of $68 per share. And while the market's stagnating, you're thinking, okay, I've got these stock positions. What am I going to do? I'm going to sell a call generate a small dividend-like income. Maybe I'm using an out-of-the-money 0.3, 0.4 delta with a low probability of being assigned. I'm just trying to enhance income and lower cost basis. What is the covered call structure? It's a capped gain. Well, you're still taking on 97, 98% of the maximum risk of owning the stock. Is it a hedge? Yeah, it's a hedge, but it's only a hedge of whatever premium you collect, 1, 2, or 3%. Anything beyond that is still a loss in the trade. And if you're doing that around earnings, instead of the 12, 15% move, you have the 20 or 25% drop, and you're still down 18 or 23% on the overall position. If you sell a call too low and it moves back up, then you get assigned for a loss. Or you have to buy it back, like we saw with that Generac position, where it's going to cost about $25, $30 to buy back that 165 call and then move it to another strike price. Okay? Capping the upside and leaving the downside open. The married put flips that. What are we doing here? We're capping the loss, guaranteed better than a stop order. This can't be violated. I've bought the right to exit my shares of stock at that price, even if it falls 50, 60, or 70%. And I have the upside open. But as the stock moves, I can sell premium. We've discussed two ways already. You've seen it graphically. I can move the put, my second working asset, one of 4 ways to reduce that risk, then eventually be bulletproof on the trade, still having the upside open and still being able to milk it for more premium and more profit. And that's where I'm at with the ONON trade. It's just that the stock now is not performing the way I wanted, even with the earnings itself. But all those income methods, 4 different ways to manipulate the put, 9 different ways to generate income against the position, whether it's just selling calls, doing it in that effect, doing spread trades inside the nested position, combinations of different trades. That's in the blueprint. It's all electronic. You can go to poweroptions.com, go to the products tab there and check it out, or you can go to radioactivetrading.com and check it out there as well. I just wanted to review that because different things and different situations. Why wouldn't I have an income method in place before earnings? Because it has to match my expectations of what I'm looking for. And if I'm expecting a strong earnings, I don't want to cap my upside. I don't want to do a covered call in this position. I don't want to do a bear call credit spread or an iron condor going into earnings either. Don't get me wrong. I don't want neutral positions. I want something that is giving me the breadth in the direction that I want, whether I'm bullish and just a straight married put, maybe I'm bearish, maybe I combine it as a long straddle or a long strangle, or maybe, hey, sometimes I buy an extra put on my married puts heading into earnings because I'm in the unknown. I don't know what's going to happen next. If it falls, I want to maybe be able to profit on the downside. That's another way to manipulate the put option as well, one of the other 4 ways. So, but on the on position, moving around different things, different expectations. Expectations were met as I expected for earnings. It's 1 month daily. There's our earnings. And then it just declined due to brief market weakness, settling down on the stock, brief market weakness, and then the downgrade by Jefferies. So that's what happened. We're down below where we were before the earnings, even with the blowout earnings. Did I maybe miss an opportunity to adjust here? Yeah, but it would have increased my maximum risk on the position, would have taken me out of bulletproof status, and now I might be at a small loss instead of where I can still get out with a small gain, even though the stock is at 25%, 23% down. Don't panic. Time is on your side. Protection in place allows you to sleep at night. That's the benefit of the married puts. And I had the upside open into the earnings, and I had the downside bulletproof to where I couldn't lose more than 3% on the trade. I could have gotten out of here for about 4%, 4.1% because of volatility on the put. Up here, I could have probably liquidated for around 5% profit. Could have done that. Maybe should have done that, but I thought this was the turn. I thought it was going to continue to move up. Could have adjusted the put down, gotten to a lower break even, but then I would be at a potential loss right now where I'm still at the positive gain. So that's part of the decision-making process. That's part of follow-up to our 4-part mini-series last week of why I don't have knee-jerk reactions with my married put positions into an earnings event. Because, hey, you saw it, you saw what happened, you're thinking everything is good, but then 2 days later, something comes out, someone changes their mind, the market's a little bit weak, and we're right back where we started. Don't have a knee-jerk reaction. Give it time. Let the market settle. Let the market figure itself out. That's the power of this strategy. of course, over other positions, where if I just bought a call, and everyone says, I'm sorry, folks, everyone says, well, the married put is just a synthetic, or married put is just a long call, but you can get a long call for cheaper. No. A long call technically risks 100% of what you invest in the trade. I'm only risking 4%. Both upsides are open. But in that on position, I would have had 10 minutes to maybe get out of a long call. Let's say I bought a September 55, September 50. I would have had about 5-10 minutes at the open to close that position for maybe a 70 or 80% profit with this move, maybe even been 100, 110. But if I didn't get in those 5 minutes, I'm chasing the bid-ask spread. By about an hour later, 45 minutes even later, it was only probably a 50% profit. I said, okay, it's going to bounce back. I've got a September call. I'm going to hold it. Well, now the implied volatility is drawn out. Now you're here. You're at break even probably. At this point, you're at a loss in your long call, and you're at a loss in your long call here. Okay. Would I be at a loss on my married put if I had opened this the day before earnings? Sure. But again, that's the idea. I'm getting into a bulletproof position so that I can go through these earnings events, follow that chart, follow that 3-month chart up and down, or 6-month chart, really up and down into these lows here, and then back up into this range here, and then back down again. Yeah, I could have gotten out for about a 9% profit up here. I regret not doing that, but I'm okay with this position because it's a great education tool. Hey, I'm down 22.3%, 22.6% on my stock. I'm making 3.3%, and I can actually adjust it now that I've seen this. Weather this storm and missed this opportunity to close here, but weather this storm, I can still set it up for profit, for further profit beyond what I'm making right now at 3%.